Hi everyone, it's your daily 10-minute business and finance news wrap for this Wednesday, the 11th of August, 2021. Later, consumer confidence, it falls to its lowest level in more than a year. But first, to my extended interview with the CEO of the Commonwealth Bank, Matt Comyn, where we talk profits, the economy and the vaccination rollout. It comes as Australia's biggest bank posts a full-year cash profit of $8.65 billion, an increase of 20%. It will pay a final dividend, a full-year dividend rather, of $3.50 per share. That's an increase of 17% and will return an extra $6 billion to shareholders via an off-market share buyback. Here is my interview with Matt Comyn, the CEO of the Commonwealth Bank. Matt, shares are at a record high. S&P today says your earnings remain robust by international comparison. So what do your numbers say about the bank's role in the Australian economic recovery?
Well, during the course of the year, it was a huge focus for us was supporting our customers throughout the pandemic, and that support continues today. That's our primary focus. For the year ending 30 June, Australia's economic recovery was strong, and on the back of that, the Commonwealth Bank's performance was strong. We didn't see the loan losses that we'd anticipated 12, 15 months ago. That's enabled an increase in profit and for us to be able to declare a fully franked dividend of $2, which is distributing about $3.5 billion, the vast majority of that to Australian households.
As you mentioned, I guess some of the upside came as a result of things not being as bad as what they could have been, but operating performance grew only marginally, and you've also got to contend with low interest rates. So where will growth come from?
Yes, very strong volume growth during the course of the year, growing well above system in all of our business lines, from retail, banking, business, institutional, and in New Zealand. As you said, one of the really challenging aspects of banks domestically and around the world is low interest rates are very tough on net interest margins, put a lot of pressure there. So, I mean, the overall increase in income over the course of the year against that backdrop, we think is a real positive. We're very supportive about the Australian economic prospects over the medium term. We believe there's plenty of opportunities for growth. As we discussed today, we increased our investment by 26% to some $1.8 billion over the course of the year. So we continue to see opportunities to both, first and foremost, support our customers in Australia's economic recovery and transition, and then two, be able to better serve and help as many Australians with a brighter financial future.
In your outlook, you say that you're prepared for a range of different economic scenarios. So what's your base case scenario?
Well, our base case is probably very similar to the Reserve banks. We were seeing that the next 12 months we're going to be, continuing on that pace of economic recovery. We've probably pushed some of those forecasts out about 6 months. So we see we're going to have a soft or a negative quarter in the September quarter. We still think there'll be some positive growth in that December quarter. Of course, that's dependent on when the restrictions ease. Come into calendar year 2022, we're seeing more than 3% GDP growth. We think the labour market will be strong again. We think we'll get down to about 4.5% unemployment, which is very good. So as difficult as it is at the moment, and it is very challenging for many of our customers, we do think there's a light at the end of the tunnel and there's better times ahead for all Australians next year.
Anecdotally, we hear of many businesses struggling because of the lockdowns. The RBA governor said recently, though, that small businesses are resilient. Based on what you're seeing on your books and given the recent lockdowns, are they resilient? And what does that say about the economy?
Look, they are very resilient. We saw that during last year. Just the resilience and how easy they were able to adapt their businesses. I mean, that said, at the moment, it's obviously very challenging, stressful, frustrating. Many businesses had just started really recovering from some of the lockdown restrictions, particularly last year, and had a few very good months. Other parts of the economy, some of the geographical locations, Sydney CBD, Melbourne CBD hadn't recovered. Some of those smaller businesses, cafes, restaurants, bars, still very challenging. So, they've got viable businesses. We're certainly there to support them. We do think there's going to be much better economic conditions next year, but there's no doubting that it's a very challenging time for many Australian businesses at the moment.
Are you seeing any stress in your mortgage book which may sway growth in the housing market?
We're not seeing much stress at all per se. The housing market's been very robust and the recovery again I think has exceeded expectations. But what we are seeing is a bit of a slowdown in activity, and you'd expect that with all of the restrictions and lockdowns. There's activity in terms of inspections and properties that are coming onto the market. So we do expect there'll be a moderation in some of the growth in the housing market and the interest in that housing market. Overall, since house prices on a national basis are up about 16% over the last 12 months, we think it's a positive for things just to sort of slow down a little bit. And so I think obviously that's leads to better outcomes over the long term. But overall, because we're so positive about unemployment coming down and the broader economic recovery that will be underway in calendar 2022, we remain positive about Australian housing into the medium and long term.
Matt Comyn there, the CEO of the Commonwealth Bank. I also asked him about the company's vaccination policy, especially for frontline staff, and whether it'll be made mandatory.
Well, there's a couple of things we've been really focused on. We've rolled out rapid antigen testing to all our branches in the LGAs that are affected in the latest restrictions. We started our corporate vaccination program initially in pilot from Monday this week. We've just in the last 24 hours rolled that out to 5,000 of our team members and also made it free and available to their family members. We did a survey last week, entirely voluntary survey, to all of our teams. We had more than 11,000 people respond, so about a quarter of our workforce responded in 24 hours. And what they told us as part of that survey was that there's only 4% of people who are currently not intending to get vaccinated, 89% that are saying they are, and 7% that are unsure. So, I mean, we're very focused on making sure that 96% can get that vaccine as quickly as possible. And of course, we're working closely with the federal government, and we'll continue to work closely with them and state governments and do whatever we can to help accelerate the rollout of the vaccine.
Given you've got such a large footprint within the community, your branches serve a diverse population, and you've got a multicultural community banking section within the organisation, what do you see as your bank's role in spreading the vaccination message to culturally and linguistically diverse people?
I think we can play a really important role there, and the support packages that we've had in place during COVID, they're in multiple languages. As you said, excuse me, we're fortunate we serve a very diverse cross-section of Australia. Similarly, we have a very diverse cross-section of our teams. As I said, I think by being able to make it free and available to our team members and for their family members, it makes sure that the information that's available on these very high quality and safe vaccines is able to get out there, and all of our team members and their families are able to make an informed decision and choice about whether they get vaccinated. So I'm hoping we can play an important role in being able to get in touch with perhaps some of those areas of the community which would be harder to reach through more conventional or broad scale programs.
Matt Comyn there, the CEO of the Commonwealth Bank. Now to consumer confidence, which has been hit because of various lockdowns across the country. The Westpac Melbourne Institute Consumer Sentiment Index fell to a one-year low in August, but it's still at a reading above 100, which means optimists outnumber pessimists. For more, I spoke earlier with Westpac senior economist Matthew Hassan. Matt, we saw NAB's business survey yesterday show confidence for businesses fall into negative territory. Yours, though, shows that consumer sentiment, while lower, isn't as bad. Why do you think that is?
Look, I think there's a few things that are supporting the consumer mood. Definitely compared to last year when the national lockdown and the Victoria's second wave of lockdown hit confidence very hard. We're not seeing anything like that capitulation. There are obviously seen some declines over the last few months, but I think the main cornerstone for sentiment holding things up at the moment is the availability of vaccines. We're seeing abroad vaccination rollouts have allowed other countries, the US, the UK and Europe, move back towards bringing virus outbreaks under control and more normal operations. And I think Australians understand that while we're going through these difficult times now, the rollout of vaccinations locally gives us that medium-term comfort that once we will get this outbreak under control and we will see a resumption of more normal activity over the course of the next year. Of course, that's still some way off in terms of where we are with vaccination rates today, and understandably consumers are a little bit more nervous about that, but that looks to be the cornerstone for holding confidence better than last year.
Consumer confidence, though, is still at its lowest point in about a year. What's unsettling consumers?
Oh, without a doubt, it's virus related. We saw some substantive declines across the three major states this month. The return to lockdown in Victoria hit sentiment there about 10%. They had been coming off a reopening last month. Queensland also down 4%, and New South Wales down a further 4%. Outside of those states, we actually saw sentiment rise. So it does look to stem almost entirely from the virus situation locally in the states that are most exposed to the latest developments.
How are they feeling about the housing market?
Well, for housing, it looks to be less about COVID and much more about the boom in prices. We're seeing a very clear shift happening around buyer sentiment. Assessments of time to buy a dwelling have continued to slide. They're down very sharply from about a third down on their November peak. And that's telling us very clearly that owner-occupiers who are very sensitive to affordability shifts are starting to feel the pinch from the price boom. Around price expectations, they're still very elevated, around near their previous highs, and very bullish overall. About 70% of consumers expect prices to continue rising over the next 12 months. 20% expect double-digit price gains. So it's telling us that there's going to be a very clear shift in the market. It already seems to be underway. Owner-occupier demand cooling off, maybe quite abruptly, but investor demand still holding in and lifting on those price expectations. So very clear patterns emerging. What's also apparent is it's across every part of the country, major capital cities and regional areas.
So this is just one piece of the economic puzzle. Adding that to everything else, how do you think the Reserve Bank feels?
Look, I think from the Reserve Bank's point of view, they'll take some comfort from today's update. Yes, sentiment has taken another knock. And it's on the back foot at the moment, but that level of confidence is not outright negative. It seems to be quite well anchored by expectations that we get through this crisis in reasonably good shape and head back towards strong growth. So they'll take some comfort from today's update that the near-term difficulties aren't spilling over into a more sustained period of weakness that'll affect the forecast for 2022.
Matthew Hassan there from Westpac. To the Australian share market now, which hit another record close. The 200 up 0.3%, 7,584. That's on the back of a good performance from the banking sector. The miners did well despite a fall in the iron ore price. For more, I spoke earlier with 1851 Capital's Chris Stott. Chris, the Australian share market keeps hitting record highs despite rising COVID levels. Why is that happening?
We know we've got successful vaccines that are being rolled out, and we can look to the UK, the US in terms of what life looks like for us in, say, 4 to 6 months' time. So really the economy was absolutely flying pre these recent lockdowns on the East Coast, and we suspect that it will boom significantly once we come out in hopefully October, November of this year.
We heard from the Commonwealth Bank today, profit reporting season's ramping up, $10 billion being returned to shareholders via both share buybacks and dividends. To what extent do you think these high dividend payouts and buybacks will be a theme continuing on this season?
We don't think it will be such a theme going forward. We think that companies will be a little bit more cautious than perhaps what they would have been 2 or 3 months ago with these recent lockdowns. We saw Nick Scali come out with their result last week. They brought their dividend back, albeit very, very slightly, just citing the uncertainty around these lockdowns and what the future does hold. So potentially companies that were in a position to announce big share buybacks or dividends may pare that back over the next few weeks.
The US passed a huge $550 billion infrastructure bill. What do you think this says about growth, both for the US, globally, and any potential upside for Aussie companies?
It's a very significant announcement for the US economy over the medium to longer term, with that being passed last night. So very big positive for steel, construction companies, aluminium companies. So certainly companies listed here in Australia, particularly in the top 100 on the ASX, are set to benefit from this huge stimulus bill that will likely be passed, we think, over the next few months.
So while that's a positive, what we've seen that's negative today is that iron ore price continuing to fall. Why is that happening? And what are the implications both for shares and for the government, do you think?
We've seen the price of iron ore come off its highs over the last 4 to 6 weeks. That's been really driven by the lack of demand out of China for steel. So we think that the iron ore price can continue to fall a lot lower from here. Let's take a step back and look at where it's trading. It's hit all-time record highs in recent months. In terms of what it means for the government here and domestically and from a fiscal standpoint, in our budget, which we had back in May of this year, we assumed an iron ore price of $55 a tonne to March of next year. So certainly that has taken some of the cream off the top from what could have been a huge, big benefit from our fiscal position here in Australia.
And finally, you focus on small caps. In that space, what do you like right now and why?
Seven West Media is a standout for us. It reports its result on Monday. We saw record ratings from the recent Olympics. We've seen that flow on this week in terms of some of their hit shows like The Voice. So we think they'll report a strong set of numbers when they come out on Monday. And we think that the balance sheet's certainly in great shape in order to capitalise on any potential further consolidation in the industry.
Chris Stott there from 1851 Capital. Don't forget you can listen to this as a podcast on the SBS radio app, Spotify and Apple Podcasts.
This On The Money stream is provided for informational purposes only. The content in this stream should not be understood as constituting advice or a recommendation. It's not personal advice and it doesn't consider your personal circumstances or objectives. You should contact a licensed professional before making any financial decision.